Hello friends, I am Anupam Sharma and today we are doing macroeconomics lesson 2 class 12 money and banking, and we are doing Reserve Bank of India as controller of money supply and credit. So first of all we must know what is money supply and what is credit. As you know, commercial banks work under Reserve Bank of India. It controls and regulates their working. It gives them directive to adopt certain policies and they must adhere to it. So these policies are to control money supply in market and their credit creation. So let's understand this. Commercial banks, they give loan to people, and this way money goes in the hands of people in the form of income. For example, a businessman takes loan, then for example for 1 lakh, then he'll buy raw material, he will give salary to his employees, wages to laborers, etc. So this money becomes income of these people. Then he will buy machines also, and other people take loan for car, for home loan, personal loan. So this way lakhs of people take loan, and money goes in the hands of people, and when they demand the goods and services, or they spend money, demand for goods and services increase. And if supply does not match with demand, then it leads to price rise, or we call it inflation. And we say that money goes in the hands of people, we call it money supply in the market. In a similar way, sometimes money supply is squeezed by policies of Reserve Bank of India for price rise. And another situation, when there is deflation, lesser people take loan from commercial banks, so money supply decreases, demand for goods and services decrease, so supply is there, so people are not demanding, so there is surplus of goods and services. So in this case, producers are forced to reduce their prices to sell their products. So now this is called deflation. And credit creation is that loan the commercial bank give to people, and sometimes it leads to credit creation leads to inflation, and sometimes deflation. Sometimes money supply increases in the market, sometimes decreases. So too much inflation or too much deflation is not good for any economy. Here comes the role of Reserve Bank of Reserve Bank of India takes quantitative measures to control credit and money supply. So there can be two situations, inflation or deflation. So in case of inflation, these measures will be taken, and in case of deflation, these measures will be taken, and these measures will be just opposite of these measures. So it will be easier for you to understand and learn. So first is increase in bank rate. So Reserve Bank of India, in order to control inflation, increases bank rate. It means that commercial banks who give loan to people, they increase bank rate. That means, for example, if bank rate was 5% for loan, it changes it to 7%. It means loan has become expensive, and people will be discouraged to take loan, and so credit creation will be low and supply of money in market will be low, and this will correct inflation. In deflation, decrease in bank rate. Bank rate will be decreased, means loans will become cheaper, people will be encouraged to take more loan, and so more credit creation, more supply, money supply in market, and correction of deflation. Open market operations, second measure. RBI sells securities like bonds, like treasury bills, etc. So who buys them? Commercial banks. Now commercial banks, so their cash reserves sink, means they fall. For example, if they have 10,000 rupees cash reserves and for 5,000 they bought securities, then it means only 5,000 left for loan. So this way credit creation will be half. So this is how credit creation will decrease, and so the money supply. Here open market, RBI buys securities. So when it buys, increase cash reserve of commercial banks, because who is buying? Commercial bank. So money is coming here. So RBI buys securities and increase in cash reserves of commercial bank. Is it okay? Since it buys, so money is coming here, and then credit creation possibilities increase. Now increase in repo rate. Repo rate are short-term loans given by Reserve Bank of India to commercial bank. So when it increases, repo rate means interest rate on short-term loans, commercial banks also increase uh, bank rate on public, and so public is discouraged and they do not take loan from, or few people take loan from this, so credit creation comes down. Here increase in repo rate, now commercial banks also decrease bank rate. Here bank rate is decrease, so commercial banks also decrease, so increase in demand for credit. Now more people will take loan, and so supply of uh, rise in supply of commercial banks. So supply of credit of commercial banks. Then reverse repo rate is increased. Reverse repo rate is when commercial banks deposit money in RBI and get loan. So it is increased. Sorry again. Reverse repo rate is increased, means RBI accepts money from commercial banks and they get interest on that. Reverse repo rate is increased. So when the commercial banks more interest on their deposits in RBI, they tend to uh, deposit more money in RBI and lend less. And again, uh, because they are lending less money, so money supply decreases. Here decrease reverse repo rate. Opposite is happening now. Since repo rate is decreased, means rate of interest decreases on deposits, then commercial bank don't deposit their money in RBI. Rather, they lend money to people and create credit. And this way, money supply increases in the market. In increase cash reserve ratio. uh, Commercial banks have to keep some percentage of their reserves in Reserve Bank, that is called cash reserve ratio, that has to be kept in Reserve Bank of India. Say 10%. Now Reserve Bank increases it to 15%. So now 15% has to be kept in Reserve Bank of India, only 85 left for giving loan. Earlier 90% was available. Here decrease in cash reserve ratio. Now here if 10% was there earlier, now decrease, they will decrease to say 8%. Now 8%, 92% is available for lending. There is another thing, increase in statutory liquidity ratio SLR. Banks, commercial banks are supposed to keep some percentage directed by the Reserve Bank of India with themselves as cash reserves. Say 10%. Now they will increase again, say 15%. So 15 here, 15 here, 30%. Earlier they had to keep only 20%, 10 here, 10 here. Now 30%. So earlier 80% was available for giving loan. Now only 70% is available. So when less amount is available for giving loan, then money supply in market will reduce. Here in deflation, decrease in cash reserve, as I told you, similar way decrease in SLR. The reserve they have to keep. Say here from 10 to 8 and 10 to 8 means 16 they have to keep as reserve, rest they can lend. So this is how control of money supply and credit is done by Reserve Bank of India. And comes qualitative control. So to decrease money supply, to control inflation. As I said, when money supply is high in market, then inflation takes place. So to control it, money supply has to be reduced. So qualitative measures. Margin requirement is to be raised. It means when a person takes loan, he has to give some security like piece of land, say a shop or a house, whatever. For example, if he takes 70,000 loan and he has to keep 1 lakh as security, security is always higher than loan taken. So margin is 30%. Now, if uh, Reserve Bank of India wants to control it or to increase it to control money supply, it will increase margin requirement. Now for 70,000, he will be told to keep 1 lakh 10,000 means 40,000 as margin requirement. So people, naturally it will become costly for people and they will shy from taking loan. Here margin requirement is lowered. Here margin requirement, that means if 30% was asked, now they are asking only 20%. So this is how lowered and raised. Now rationing of credit. Fixes credit quotas for different business activities. Now when they have to control credit, they fix quota for different businesses and accordingly they can give loan. So sort of restrictions are there to give loan to people so that limited people get loan and banks create credit. And here rationing is either withdrawn or made simpler. Moral persuasion. Advisory to commercial banks to restrict loan. Here again to restrict money supply, they give advisory and generally they are mandatory by way of giving lectures, seminars or circulars and giving advices. So this is called moral persuasion. And here they want to restrict loan. Here they want commercial banks to be liberal in advancing loan. So students, I hope you like this video. Please like, share and subscribe and don't forget to press bell icon button. Thank you.